Hello and welcome to another episode of the Dust Suckers. How are you doing, my friend?
I'm good, Ramon. Thank you. It's good to be here again on the usual Monday morning.
Monday morning, yeah. By the way, we have to ask you apologies. We had some problems with the microphone, but we believe that now we have solved it. So we're gonna be as loud as possible in both sides. So let's see let's see how it ends up.
Yeah, and I think we've got a very interesting podcast coming up today, discussing investing, which is something we get a lot of questions about, of course, and hopefully we'll be able to help people a little bit.
Yeah, absolutely. Well, so today the main topic of the talk is about investing styles. So everyone has more maybe disposition to take risk or less, or is totally scared of investing or don't know where to start. This is actually like a common topic, but we won't cover the where to start. We will go to how Joey invest, what is Joey's style, and what's mine. And we're gonna cover this because we are asked many times for different people along our way. Hey, I want to start investing, but how I buy my first stock, or what should be okay to buy, right? And usually our answer is like, it's a little bit long. You need to first understand yourself. You need to understand what verticals you believe they're going to lead the market in some years. Are you going to cash it out in 5 years, in 10, in 15, in 20, in 40? What's your take on that, right? So we're going to discuss into that, and I think the best way to start this is to ask to Joy, because Joy is the person who is the technique in this matter. I'm more like an aficionado, so I follow every day the stock market and the trends and Bitcoin and everything. But Joy is the person. So please, Joy, show us a little bit like how is your investing style? What are the verticals you choose? What is the mix of dividends and not dividend stocks? So like what is it?
Yeah, so it kind of depends on where you live, of course, and tax law drives it to some extent. So in the Netherlands, I had full freedom to do as I liked. So basically, there's no capital gains tax. There's dividend tax, but that's like common in most countries. Here in Portugal, it's slightly different because we are taxed on capital gains. So if you buy a stock at 100, you sell it at 228 under the non-habitual resident scheme. 28 euros of that 100 would actually go to the taxman. So that kind of makes you, in a way, invest differently unless you set it up in a holding company, of course, which is a completely different story. So what I try to do, I try to make as much money as possible from dividends. Why? Because I don't like to have the big swings in the portfolio, and the swings will still be there, but you don't look at net worth based on the assets, the asset value of the stocks. Really
One question. I like to interrupt you for one thing. I think it's beneficial that if there is people who is listening us to understand what is a swing in the portfolio. If you could frame that.
Yeah, so anyone who's basically traded or held any Bitcoin knows that it went from $65,000 and it dropped back to what, $18,000. Now that is a big swing.
Yeah.
If you've got all your value, all your net worth in Bitcoin, that is a huge drop, and that means that, let's say you are super wealthy and you like you had 100 of them. That is a multi-million-dollar drop then. So this is something that you want to avoid, right? I mean, you don't want to be angry and depressed all day because Bitcoin went down or because your stock prices went down. So you want to actually focus on cash flow. Cash flow means that you want to have a stable income every month, which is the best alternative to having a job. Because in the end, the reason why we're doing this is because we're trying to to have an income either next to having a normal day job, or because it's your main income. I would always recommend to have it next to a normal job, and then you basically try to get as much cash profits paid from companies that you own, and that's always been my style. At least more recently, it's been transferred more and more towards that.
Amazing. Great. Go on, go on.
Yeah, so what I try to do also, because that's part of it. So a big part of it for me is actually to go for dividends. Now, if you'd be a Dutch person, you'd look at, for example, Royal Dutch Shell, the oil company, or the energy company, I should say, because they're trying to transfer more to clean energy, of course. So if you're British, you'd go for BP maybe, and those are real good dividend payers. Then you have utility companies. So your energy company in Finland, you had Fortum, for example. I think that's one, and in Denmark you have Ørsted. Sorry, and in different countries you've got different companies. You've got retail chains such as supermarkets and so on that always do reasonably well. You've got the Nestlés of this world. So all those are paying a dividend. And then, of course, you've got the high-value dividend payers, which really pay over 10% per year. Those are normally a little bit more risky, but at the same time, they can be good cash flow generators.
Do you have how if you look at your portfolio, like it would be a cake diagram, and you see like okay, I have this much value stocks, this much Bitcoin, this much real estate, this much whatever. How much each percentage represents the dividend stock for your portfolio?
Yeah, so if we go by asset class, about a little bit more than 10% is crypto. That is half of that is Bitcoin, and half of that is basically altcoins that I think could do really well. I don't plan to sell them. I don't plan to trade them. I've just very recently formed that portfolio, shaped it, and I plan to hold it until 2024, hopefully 2025. And then we'll see where we end up. So that's something I just don't want to touch. Also, because of tax law, you don't want to pay capital gains tax. If you hold it for more than a year here, it's not taxed. Then I've got about 10% in precious metals. So that's gold and silver. They're actually really physical metals, so I have them in a vault in a centralized, not with me, but with a third-party company.
Yeah, really clear. He don't have it in his home. Don't go to stall him. You're not gonna get even a cent.
No, don't even try. We have a dog as well, by the way, so I would definitely avoid that. He's not friendly. So we have, and then the other 80% is mostly stocks that basically paid dividends. I would say out of the 80, or let's say 70 to 80%, half of that is actually are stocks that are paying very good dividends, and half of that are swing trades. And swing trades means you try to buy something when the market doesn't want it, and you try to sell it when everyone wants it. That's basically what you do.
Exactly. Well, sounds good. Doesn't sound too far away from mine. But what surprised me is that you say that the 10% is in the asset class of crypto. I expected a little bit more.
No, I think it used to be. There was a time in 2021 in before let's say in November even. When the peak formed, where it was more than 50%. It was 60% at some stage.
Wow, you were all in that time.
No, yeah. Basically, what happened was I bought a couple of altcoins like Holo Chain, and there were a couple of other ones, and they really went so incredibly well. Bitcoin was one of them, of course, and there were a lot of these smaller altcoins. And from a 10% or something, it went to a ridiculous amount of 60%. And
wow.
What I've done, I basically held that until January 2022, so after the peak. And when Bitcoin was around $48,000, I started selling. To me, it was already quite late. I understand that, but at the same time, if you've come from $3,000, $4,000, selling at 48 is still great, right?
It's still great, yeah.
Yeah, so that's what I've done, and that's 60% reduced to 10% at that time, and the money that I've taken out, a part of that was for living expenses, and a part of that was also for a big part of it was actually reinvested in stocks. So, and those are the ones that pay dividends. So you gradually try to reduce your risk as you get older. That's actually the general idea.
Wow. It's actually like really complex to get into that decision when you have been holding something for a long time, and you are like you knowing that this the value is dropping, and then you are like, okay, when is the time to execute and protect my portfolio, and what I'm gonna do with that, and then to switch to another thing with the same money. And that, I think that's wonderful. I asked you, I think it was in the second episode or third. Yeah, we don't have that many, so it's not complicated to remember. But I asked you about that, and I told you that I have done the opposite. I have took taken dividends from stock market and flew it into crypto. So I done the opposite way.
Yeah,
I have now, this especially this week, hunger of altcoin rally in this case, and I have fear of stock market downside. What's your
yeah.
take?
Um, I find it really hard to predict crypto markets. There's a very simple thing that we've seen so far, and that is if you look at the 4-year periods, of course, you've got 1 year of a bear market, then you've got almost like a year of consolidation or basically accumulation phase, where
Mm,
people start getting demotivated with crypto, where people start thinking, I don't want to be in this market anymore because it does nothing. Bitcoin is boring. Ethereum is boring. Everything's boring.
yeah.
And the altcoins, the smaller altcoins, they just keep going down. Now that's
Mm,
the normally the final phase of the altcoin market of the crypto market, and that's when and Kobe, you said this as well. That's when you actually need to Kobe on Twitter, by the way.
yeah.
Most people will know him. That's when you actually need to stay in because that's when you can get the best purchases, the best prices for your coins. So I think we are now in that accumulation phase. It could be that we're doing hitting resistance and going back down again towards somewhere between 32 and 20,000. Who knows?
Hmm.
To be honest, it will not change my view.
Hmm.
I know that this is all part of a bigger accumulation phase. I don't see it going down to a new a lower low. With regard to stocks, yeah, stock markets very much depend on what the central banks are doing. And if the central banks are pumping money into the economy, quantitative easing, then normally you'll see that asset prices are going up. If they are doing tightening, then you see asset prices going down. There's also an economic risk of an economy risk. Are we going to get into a recession? Everyone talks about it. As far as I can see it now, the markets still look quite good as long as we stay above 4,200, the S&P 500.
Hmm.
If we go below 4,200, then I think we might get a very, very big correction this time.
Yeah, I was listening this weekend to Delox. Delox is one Spanish trader who I also follow, and I also listen in his podcast. And he's been saying all over the time that he has a put on the level of 32,400 of Bitcoin, that when it breaks that barrier, is going to short it.
Mm-hmm.
And he believes that we are going back to the nearly like 14 15,000, and then from there we will go like for real up. And I wanted to know what is, you just say that you don't believe that we are going to go back, but have you read about this scenario, or have you listened, and what is your gut feeling about it also?
Yeah, I'd like to know what people base that on. I mean, there are certain people that base it on the history of Bitcoin. So if you look at the previous cycle or the cycle before that, you see that there were very often two lows and two dips. So basically, or the first bear market ends up in a low, you get a recovery, and then you get the final low. And that is possible. But if you look at 2020, for example, where we had this March low that was really really deep, that was actually, in my opinion, it was a black swan event. It was the pandemic. That doesn't happen every 4 years, hopefully at least. I don't want to go through that again.
Yeah.
So I actually, from the charts, very often I take that out of the chart analysis, because in my opinion that was such an anomaly that it should not even be considered a part of the chart almost. It was a short-term liquidity thing. Basically everyone started selling at the same time, and you get an overshoot. Will that happen again? Maybe if there's a banking crisis, I can see if you create a big enough crisis where everyone is basically going to panic and sell everything. Very often they need to do short covering, and if they need to short cover and do short covering, it means they went short a certain asset, the price goes up, and they need to buy it back, and then you get this strengthening factor of it. It basically they need to find the money to buy it back, so they need to grab that money from elsewhere. So they use the profitable asset classes. So if they made money on, if their Bitcoin is in profit, they would sell that to buy back the stocks that they actually are shorting. And that's what happens in liquidity crisis. You basically see money shifting from one to another asset class, and that is a risk, but I don't think anyone can predict that at the moment.
Yeah, no, of course, I don't think that is predictable, but some scenarios are there. Another thing that is generally in my head is about like, so you have your portfolio, and then you have different asset classes, but I read, I don't remember where, but because as you know, I try to learn as much as possible, but sometimes I don't remember where I read things. Maybe because this ADHD thing that it makes me already complicated to read anything. But when I read it, and I get the idea, and I forget everything else. But I read that somebody was saying that you don't have a mature and professional portfolio if you are not long in some companies and short in others. And my question to you would be, am I a bad investor if I don't short anyone and I just decide to not do anything? Like, I don't go long, I don't go short, I just don't support that stock or that asset class in any way. I just go to the things that I think are fine. What you can say about this?
Yeah, shorting is there's a cost to it as well. So a lot of retail investors don't like to short things because it scares them. And you basically sell something that you don't own, so you're borrowing it, and then later on you have to buy it back, basically. So at first it feels like if you short something, you get money into your account, and you feel like you have more cash, so you can buy something again, because that's how it works in the end. The problem is that you need to, if you're short, you need to understand that you are paying dividends. So you're not collecting, but you're paying dividends. So if you're shorting a dividend stock, then that's a cost factor. And then there's also costs with your broker normally for shorting stocks. So that's almost like a risk premium, I think. So those two things you need to take into account. I would say that it is wise to have some short positions next to some long positions, because when you get a stock market crash, you benefit from it with your short positions. You could buy those back lower, so the cash that you make with that are actually is kind of limits the damage when during real stock market crashes. If you don't want to do that for whatever reason, I would recommend that people always keep a good component of cash, and that doesn't make sense in most people's opinions, because cash doesn't pay anything. Cash just sits there. You have 5, 6, 7% inflation, and you're thinking, why should I keep it in cash? The reason why you need to keep it in cash is because you don't know when a stock market crash comes, and then you can use it to buy back lower. That's the main reason. So if you don't short, have some cash.
That's so good, so good. Yeah, I've been thinking lately to, or kind of selecting to short some companies and also some industries. Just going to the industry way, because the way I think the whole financial situation of the world now is advancing,
Mm-hmm.
it feels for me that there is certain industries that they are kind of they're gonna suffer as a whole anyway. So kind of maximizing the possible pain and gain.
Mm-hmm.
I try to think in the industry, but I haven't done it yet, and I will. I will definitely get your help when I have to, but I haven't. So, but I do that. I do what you say. I try to have something available for sales time, right? When it's the time to buy, then you can buy something. And but the problem is that with these ups and downs that we've been having, not only in well, especially in more crypto, but in stock market now. Um, it smells that there is something coming up because now again somebody was saying that what the hell, like Tesla stock is like $256 yesterday price, and uh, I think it was 6 months ago it was 98, and this is one huge company, one
Yeah.
stock. Think about that. If you think about in millions flew into to this stock, there's somebody that has made a 100 something percent, right? Insane.
Yeah. Same with Nvidia.
Exactly, exactly. Although I have to say this, I was maybe 2 weeks ago, sorry, a week ago, with one friend who's related to the AI world, and he works, sorry, he works for a top company in the industry also, and he said for me that this cannot be that long. This has to, there's gonna be some problem here, and they say that, yeah, we are expecting already the AI winter, and I was like, what the fuck? Like really, AI winter? That word exists already, you know? And for them, that it's simply like it's for us in stock market and crypto in general. Um, for this industry is also used. Uh, well, one thing more I would like to ask. For example, do you consider or what is your opinion when you think about real estate? Because we have talked about this. I like more real estate than you, I think, but I'm not sure if the reason is because you are more expert on trading and you go just for the stocks and you are happy with it, or what is it?
No, I think real estate is. I think it's a messed up market, to be honest, and I think because there's too much debt involved. You're in a market where the normal people, normal families, cannot buy real estate without borrowing. So that's okay to some extent. We know that. I mean, Henry Ford started with the T Ford, right? I mean, no one could afford the cars. Everyone wanted one, so the demand was there, supply was there, but they couldn't meet because people didn't have the money. So he started saying, why don't we just borrow, let people borrow money? They take their earnings from their salaries from tomorrow, the day after, and so on, and then they spend it today, and they can still have a car. With housing, I understand that as well, but there's a limit. We used to say that 30% maximum um, of your monthly income should go into housing, into your mortgage and housing related costs. Could be an interest loan, for example. I think for a lot of people that is a lot more, and then there's the risk that they lose their jobs, or that one of the parents loses the job in some cases, or that the interest rate goes up and then you get a rate reset. So there's so many factors involved. Now, what we see at the moment is that all those things are coming under stress when the interest rates keep rising. So at some stage, people cannot afford properties. And then you see all these interesting stories in the news. I'm sure you have them in Helsinki as well, where they say, yeah, but the property market is really tight. Yeah, okay, it could be really tight, but
Exactly.
maybe the supply of Lamborghinis is also very tight because if everyone might want one, but the supply is very tight. Yeah, but do you have a balance where the price, supply and demand can meet a price balance?
Mhm.
If that's not there, then you could still crash a market basically, despite everyone wanting one. And naturally, you'd say, yeah, but we need
Wow.
then a free market will then find a balance again, and then maybe the sellers will actually reduce their prices and then meet the buyers somewhere. Now, what do governments do and central banks say? Yeah, we need to make borrowing more easy. So we're going to make sure that the new people who are just basically newly graduated, they can borrow more. Or we can, this restriction here, okay, then you remember the ninja loans from the previous housing market crisis? No income,
Uh,
no job, no assets. Ninja.
yeah, yeah. Well, it wasn't my situation, but I can tell you that in 2006, exactly in 2006, I was offered an insanely big loan
Hmm.
for operating my business. I was in real estate, as you know, so I, I was stupid enough by that time that I took it. And I didn't even, by that time I was just going with the flow and not buying and selling. I was optioning properties basically. So if you would sell a house, I would come to you and you would say, "Hey, Ramon, yeah, I want 200K. I would give you 10,000. I would ask you to sign a paper and keep the house for me for like 10 months or something, and then I would sell it in the price I want, and you could not say no to sell, right? So with this money, I built my own money supply, and then the time where Lehman Brothers crash came and the wave came to Europe, it started to slow down the stock market. And when the stock market was slowed down, there was all over the press, all over the news, and in a matter of weeks, most of my options were lasting the time
Hmm.
limit, and I lost them. So I went into a bankruptcy just because of those ninja loans. So I know really well what the fuck they are.
Yeah. So, and do you see the same things happening again in the market now? Do you see
Yeah,
similarities?
I see. The similarity I see, the number one similarity. Nobody believes me. Nobody want to, like, nobody seemed to care. But
Hmm.
there was something similar in 2017, and nobody is speaking also about this because I will explain you later. But it has to do something with Corona. But uh, 2007 approx, before Lehman Brothers crash. I don't remember the date, but anyhow, um, I was getting emails and I was getting letters at home,
Hmm.
like kind of advertising credit a lot and making it very, very easy that you will get the credit. I put you an example. When I got my loan in 2006 to operate my things, and I also did the stupid thing. I bought a car with the same loan and blah, blah, blah. Anyway, but um, I got a letter at home with a gold Visa card that there was with a 6,000 euros limit. It was the normal thing back then. Maybe now they are 10,000. I don't know. I don't have a credit card, so I don't have any idea. But um, I went to the bank and I was like, hi, I haven't asked for a credit card and you have already sent it. And they say that, yeah, it's just because your because of your how is it, cash flow, and you don't have any problem, we have give it to you and it's free, so you only have to activate it and there is 6,000 euros there. I was like, it's free, okay. Think about, I know I was early with my business, but I was like 20 years old. My story is crazy. I started very
Hmm.
early, but anyway,
Yeah.
but I didn't have financial education. I didn't know what the hell was it. I didn't know what was some interest rate. So I didn't even heard about I'm paying something ever. Completely stupid madness. So I took that card also. You know where that kind card ended? In the day that the crisis came, and I didn't have money to pay the bills, I cashed out the 6,000 from an ATM, and I put it in the bank to pay the debts that I had. And then I had the debt in the credit card.
And a much
But
higher interest rate.
yeah, of course. But everybody who didn't have financial education did that. And look at me nowadays, speaking with you, making a finance podcast, and
Yeah.
investing in different asset classes and real estate, blah blah blah. But there was a day where we didn't know any of that.
No,
Nothing.
because they don't teach you that in schools, do they?
They
That's the
don't
problem.
teach you. And the other thing, they were sending also emails, and what I see now is that my wife, for example, and I don't get that in Finland because I'm a new resident. I haven't make that amount of business that is kind of approved by by the banks, that they're like, okay, we're going to give you 500,000 here is. But my wife is getting those, and other friends are getting those emails telling you, hey, there's 40,000 euros to do what you want. You only have to push here, 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 and in 1 minute you get the message sent. And in the same day they ask you, and they wire you the money to your account. And I was like, this smells like problems. It can't be that easy. And the difference I see, and with this I end my part, the difference I see is that it looks more complicated borrowing for real estate than borrowing for yourself. If you have to ask 30K, 40K, because you have to do something, and kind of debt that you take that you don't give explanation to anybody because it's on your name, that's it. But the money who goes into real estate in Finland, there is so much tightening, for example, yeah, and in Spain also. But I heard like a year ago they were saying that in Finland, if you want a 400,000 loan, you need to make at least 60,000 per family every year, otherwise they don't give it. This was one of the new things, and now that this regulation has come even higher. Plus, the real estate market here is around not 30, but maybe 27% down, and the time span to sell a house, it went from from 3 months to 6 or 9, something like that, between 6 and 9 months. So I don't get this money, why money is easier for for your personal finance than actually for an asset. That, in my head, the logic says that it should be the other way.
Yeah, I agree. Yeah, that's a bit strange, isn't it? It's a strange market, and what you see also, there's so many markets where people are over leveraged. The Australian market was always a good example, where people bought one property and used the extra equity to finance another property, and I still see people doing that. It's a risk, and when the banks are really going to feel the pain, that's when they're going to start forcing interest rises on the loans, outstanding loans, especially when properties are underwater. Sometimes they can go back to you and say, hey, you're paying 3%. We're going to make it higher than that because your property's underwater. So those are a real risk, actually. And
do you want to know?
Yeah.
Sorry, I just remember something also that blew my mind. Do you want to know something even more crazy? Well, I will put myself in risk now. I will look stupid if I say this, but I prefer to make it exciting in the podcast because I don't want to be like person who believes knows everything. So if you would be a bank and you want to tell to everyone how probably is that there is coming some recession or there is coming some slowdown in the economy, and wants to help your customers taking the right decision and so on. If you need to take historical data to say for them, hey, this looks for us that is this kind of effect or this kind of event or this other, wouldn't you try to get as much years as possible to give like a visual, easy to compare, or would you make it like really short?
You mean the loans, the duration of the loans?
No, the historical data that you need to analyze to tell to your customers, hey, we are good or we are bad. Do you think the bank would give like a 30 years history analysis to tell you that, hey, in our opinion, we are not that bad, we think we are good? Or do you think they have to look more close, like 5 years or something?
Well, it kind of depends on the bank doesn't report to customers in the end, right? I mean, the bank reports to shareholders normally, and the shareholders don't like to see the bank taking a loss on certain outstanding loans. So if the asset values of the outstanding loan that are basically backing the outstanding loans are too low, then someone needs to take a provision in the bank, and that means a multi-million or maybe even billion-dollar amount to make sure that the shareholders are not seeing it as too risky of an investment, and it's basically normal accounting practice. So I think that's why the bank sometimes has to do short-term, has to take short-term actions. It's driven by legislation, of course, but it's also driven by proper risk management. So yeah, and sometimes the interests of the homeowners are not the same as the interests of the shareholders in many cases.
Makes sense, but I will tell you why I built this weird case. I asked to. I have a relative in my family that is a banker, and the whole family has been a banker for 40 years, all of them, and I think they don't know mostly any of my activities. They know I'm in business, but they don't know anything that I'm doing. And I said for them like 3 months ago, hey, what is this? What's the bank gut feeling about the economic slowdown and the whole recession fear and the possible liquidity crisis, banking crisis, etc. And they say for me, yeah, we have been talking about this, but regarding our data, there's nothing to worry. And I was like, what? There's nothing to worry, but what data, what you are comparing? Like, yeah, no, we are comparing for the last 10 years episodes in like how the market has been moving. And I was like, so you don't take into account even the real estate bubble and the subprime mortgage 2007. You don't take any of that. And a little bit before to 1990, there was also something. No, we don't take that long. We just take 10 years like to analyze what's happening now. So basically, they are looking into 2013, and of course, they don't have enough bad data to tell to anybody or to take any decision just to cover themselves. But I was in my head, maybe I'm not clever enough in the finance world, but I was thinking this looks that it's not enough or it's meant to be to satisfy somebody, but it doesn't satisfy me, because if you don't take into account the same practices, the same ways of getting customers to obtain loans that they were done nearly 20 years ago, 17, with the Lehman Brothers crash, I think we are missing something really big here.
Yeah, but there's that, and in the end, there's also, if I look at my first mortgage in when did I first buy an apartment? It was in 2002, I think, or something. My first mortgage was a scam, basically. It was a complete scam. It was one of those guys from an insurance provider or mortgage provider, mortgage lender, who was basically one of those. He was like one of those second-hand car salesmen, and he just wanted to get his commission. And he comes to your house, and they say, don't worry, we'll come to you. And he's got a nice three-piece suit, and his little printer, and he's got all these. If I do this, then I can save so much your monthly expenses. And in the end, you can say, that sounds really good. A lot of low monthly expenses. I like low monthly expenses. And then you find out that you're actually really being screwed over because it's linked to this fund, which is not performing. And in the end, it's all based on assumptions. So there's the bank. If you look at the higher management of a bank and the shareholders, they will have a long-term view, and they will definitely take into account that a 2007, 2008 crisis could still happen. If you talk to the lower levels of the bank, they will say everything's fine. Now, if you go back in time, let's say we get the DeLorean and we go back to the future or whatever, and we revisit 2007, 2008. How many people do you think within those banks or within working for those mortgage lenders saw the problems coming? There were a couple, and there's a reason why there's a movie about it. It's because someone predicted it. One person predicted it, and maybe there were a couple more. There were a couple more that actually had
Mr.
short bets.
Mr. Michael Burry.
Yeah, Michael Burry was one of them. Yeah, and there
my
was
favorite.
yeah, he did really well. And he saw things coming. But why? Because he had his feet in the dirt. So he was actually talking. They were going out in the market, and everyone must have seen the movie The Big Short.
Mm-hmm.
And they knew exactly what was happening. They knew strippers had 3 mortgages or 3 houses, and there were people with the ninja loans, and they saw this can't go right now. At this moment, I think that is less of an issue than it was at that time. So while there are certain people who really go too far taking on loans, I think that's not the main issue. It's basically it's a completely different problem now. It's basically asset values dropping, and seeing how much exposure there is that we don't see, and that's always what scares me. What is it that you don't see? What are the derivatives on top of the housing market?
Exactly, but the point of this is that 90% of the population is not talking about this right now. Like, and this is what like drives me crazy. That when like we are all human beings, like in the first world where we have the luck to live, most of us either you have a loan or you have a rental apartment, and but many people has a loan, many people own properties. You need to take care of your portfolio and of even not portfolio. If you just you are not maybe interested in investment, but you own a house, you, your house could be in danger depending on these market moves and things that happen. And I don't understand why there's been like such a always kind of secret around all of this. But anyway, what I think, my friend, if you are fine and you don't want to add anything on top of that, what I think we have to do now is we need to comment the latest news that they are really hot this week. And let me throw the first, and then you continue. Um, what about FEDNOW?
Yeah, it's a good question. I mean, everyone is there was of course for quite a while we've had the inflation story, right? And everyone was worried about inflation. Then before that we had the zero interest rate policy, ZERP. We had a low interest rate policy. I cannot see you anymore, by the way. I think you're probably leaving. And so we
Sorry.
no worries, no worries. I just wanted to make sure you're still here. Otherwise, I'm just talking to the podcast listeners. That's fine as well.
Sorry.
Um,
Yeah.
so with those low interest or no interest rate policies, you basically create some kind of a bubble in asset prices. Now, in order to that's why stocks were overvalued as well. So in order to limit the issues, they have to, and the inflation, they have to raise interest rates, of course, and that's what they've done. Fed has done that. The UK, Europe, all the big central banks have done that. Now, inflation is coming down. So there's no doubt about it. Inflation is coming down. The oil price is lower. It trades at $70 now. Um, we've seen copper trade lower. We've seen iron ore prices go down. So all the food prices have come down. But the problem is that it still remains quite sticky, because even at 4 or 5% inflation, it is 4 or 5% on top of the earlier inflation of 8% that we had, and on top of the inflation before that. Salaries don't go up that's the same way. And now, of course, what central banks are trying to push for is to keep salaries at an acceptable level and to make sure they don't rise too fast. So at some stage, you're going to see issues there. I think that's where the recession could come from. It's when the normal people don't have the same amount of money to spend anymore from the salary that they make. And I think that is the main risk. And then if you put a housing market on top with higher interest rates and asset values dropping, I think that could become a really ugly situation.
Definitely. Um, I wanted to get a little bit more in the dirt with the Fed, and I think I didn't say or pronounce it hard enough, but I was talking about it also makes total sense. But I wanted to comment about this payment system that the Fed is including. The Fed now, it's called Fed Now,
Mm-hmm.
and I will just share you my screen, and I want you to um, I want you to tell me What do you think about what you are reading? Because I think it's crazy. So you see my screen, right? You see my screen? Okay, you are muted. Everybody,
I can see it,
now.
yes.
Yeah. Perfect. So this is the site of FedNow right now. And it's launching in July 2023 instant payments with the FedNow service. Green, the photo in the background. Green acres, lawn care, bank, credit union, like everybody's happy there. And there is this green mansion and green mountains, like we're gonna be greener, we're gonna be your friend, like blah 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 blah. Instant payments 24/7. So I heard that FedNow is launching this payment system, and there is a conversation that, I'm sorry, I don't know where the hell it comes, but there is a conversation. If you Google enough and you go in Twitter, you will find it, that this could be built on XRP and on Ripple. And the conversation is getting that ugly that they are saying that this will be like the solution that the Federal Reserve has found to stop the problem of the expensive wires and scalability of transfers around the world. And this could kind of destroy part of the banking system itself also, because they would only ask you like maybe some like 4 cents or something like this. And the conversation go even further than this, because when you are making transactions on crypto or any of the blockchains, you pay gas fees. You pay sometimes more than a few cents. You pay like maybe $1, or depends in which, so over which blockchain you do that, and with which coin, which is could be I don't know, Solana or a VeChain or Ethereum or whatever. There's always a gas fee. So they are kind of saying that with our system, you don't need any more token. Like, fuck you, token. Like, the token is built in a way that the people will validate the transaction, and in the transaction, you will pay them a commission. So Fed is doing their own shit right now. This is like blowing my mind. What's your take about this?
Yeah, no, we know that. We know that obviously all the central banks are studying the blockchain, are studying all the cryptocurrency projects that are out there. Bitcoin, we have Lightning Network and all that. And obviously, what central banks, in the end, what governments want, I would say, is they want to make sure that they get their taxes. That's the main thing. The main thing is getting the taxes paid. And one way to do that, of course, is to make sure that all the money stays within their currency, in their little economy. And the second thing they want to do is they want to have control over whether it's used for the right purposes, the money. So they want to make sure that they can see all the transactions. And that's, I think, where these kinds of payment systems come in. It's control. It's making sure that you are using it not for money laundering or not to support Russia, for example. And all those things will play a role, of course. And that's basically something where we need to question, where is this going to go? Don't think how easy it would be now. Think, where could this be in 10 years from now?
Exactly. Like if they are planning to introduce this massively around the world, I think we cannot do that anymore. That I'm going to send you, if we go for dinner one night or something, or for lunch, and then let's imagine that we go to a good restaurant to celebrate some good deal of business that we made, and we spent like 250 euros only for the food, and then we spent 200 euros more in wine, and then I wire you $400 because you paid for whatever, I don't know, and I wire you my half. There's gonna be a time that this is not gonna be possible anymore without somebody wondering like, why the hell you just pay Joey, and did Joey, is this counting on your tax card now for this year? Do you have you earned those 400? Are those 400 euro like breaking the barrier of, I don't know, 70k, and starting from 70k maybe you are taxable with a new layer of tax that maybe instead of 28, maybe it's 32. Like, what the hell, really? It's like, I hate this.
Yeah, and that's the reason why I think. Okay, I know a lot of people are saying that Bitcoin was invented, or the white paper was written by the U.S. government. Um, to be honest, I don't know. I like to see it as some kind of a person who had no interest or no personal interest and just wanted to create a better world, basically. And I think that's something that might have been tried at least with Bitcoin. I'm not sure whether it's going to happen, whether it is going to be that privacy. I think privacy in Bitcoin and blockchain in general is overrated, because you could basically see everything, and you can see what's happening to Binance now, how they're being blocked from using from creating accounts for certain people in certain nationalities. So that's something that I think the privacy aspect is gone, pretty much. So it makes it a little bit more difficult to keep things hidden. I think that will continue. I don't see how that would end.
Absolutely, absolutely. Well, I think we got a hell of an episode today, talking about really really deep insights. I think your dog want to get out. uh, just
You can
kidding.
see him here, indeed. He's trying to get out of the room.
Yeah,
My wife just got home.
he knows that we try to keep the episodes in 50 minutes, so we are close to it. Anyway, interesting. Thank you so much again. And well, I think will continue trying to find interesting topics to talk about. This was definitely one of them that we need to improve. Remember, you can go if you are listening this now and you forgot from what Joey said. I think between the 15 minutes and the 30 minutes, he was giving you the best advices on the portfolio building. So just scroll there and listen. And if it's the first time you listen us, thank you very much for being here. We are the Dust Suckers, and this has been another great episode. Thank you very much, and see you soon. Bye bye.
Thank you, Ramon, and see you next week again. It's been a pleasure.
Yes. Ciao. Bye bye.
All right. Bye bye.